Hi, welcome to STANLIB's weekly economic podcast. My name is Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And obviously, the war in Iran continues. We're in the 17th day of that war, and I think already it is longer than what most people anticipated. The oil price is staying over $100 a barrel, and there doesn't seem to be an end in sight within the short term. Obviously, we're looking at the implications of the higher oil price for inflation. We've done quite a lot of work around South Africa's potential inflationary impact, but the same is being done around the world. And obviously, most central banks are likely to get rid of any possibility of an interest rate cut. And some of them will be contemplating an interest rate hike, although I think they'll take their time to move to that as a conclusion. But clearly, the longer the Iran war lasts, the more damaging it will be for economies broadly, for confidence, and a whole range of other indicators. At the same time, obviously, financial markets are under pressure, both bonds and equities. There's generally a risk-off trade unfolding. All of that, I think, would bounce back quite quickly if there were a end in sight for the war, a compelling end. But as I said, I don't think that's or doesn't feel like it's imminent right now. But things can change very quickly. So I think for this week, we're going to focus on the US inflation data that was released last week. The numbers still look compellingly good and well behaved, but clearly there's a significant fuel price increase that the US is going to have to factor in their next month's data and then potentially beyond that. So maybe useful to look at some of that information. And then the second topic is South Africa's GDP performance for the fourth quarter of the year. It came in, I thought, a little bit disappointing. It ended up with the South African economy only growing by 1.1% last year, which is far below what we would ideally need. And so the focus clearly this year is on how we can get that growth a lot better. But right now, South Africa is also facing a very substantial increase in the petrol and diesel price, which will obviously undermine some of the positive growth dynamics. So two key topics to discuss. They're not particularly uplifting topics, but I think important to understand some of those dynamics as we go through the next couple of weeks, and hopefully the Iran war ends sooner rather than later. So let's start with the US inflation data for the month of February. The numbers were released last week, and they were exactly in line with expectations. During the month, the headline inflation rate in the US went up by 0.3%, and what that did was to keep the annual rate of inflation unchanged at 2.4%, which is quite frankly not far away from their target of 2%. If we look at their core inflation rate, that went up a slightly lower 0.2% in the month, which meant that the annual rate of core inflation remained unchanged at 2.3%. So you've got headline at 2.4, you've got core at 2.3. Those numbers are very close to the target of 2%. So on the face of it, it would appear that inflation in the US is, for the moment at least, reasonably well under control and in sight of the inflation target. The problem, I think, is twofold. Firstly, there is a bit more evidence that the tariff pressure is revealing itself within some of the underlying components. I don't think that's hugely problematic because subsequently the Supreme Court in the US has ruled that the liberation tariffs were illegal, and so those have been scrapped, and in its place the Trump administration has put into effect a 10% tariff that is in effect, I think, for 150 days. And in that time period, they'll have to come up with some other alternative. But what it means is that the average tariff level that is applicable in the US has been moderated quite considerably, and so it should ease some of the concerns about tariff-related price increases. The other issue is obviously the oil price. We've got none of the latest spike in the oil price included within the inflation data, and the increase is very substantial, and so down the line we're going to see headline inflation move up quite considerably, and then depending on how long the Iran war lasts, it will start to feed into broader based inflationary pressure, and the more it does that, the more it will concern the Federal Reserve, and ultimately it could well force the Fed into a hiking cycle. Now, that isn't our base case. We're assuming that the war in Iran will end within a matter of weeks rather than a matter of months, but clearly that is a significant risk. At the same time, I think it's worthwhile mentioning that the core PCE inflation data came out on Friday, and that was a bit more elevated at 3.1%. And for many people, that's really the underlying inflation rate in the US, certainly the inflation rate that the Federal Reserve pays most attention to. And the fact that that has been moving up in recent months, again, will concern the Federal Reserve. So the net result of this is that for the moment, the Fed will want to keep interest rates on hold. I think there's very little prospect of a cut in interest rates anytime soon. In addition, they'll want to flag that if this turns out to be a temporary shock in the oil price, then there's no need for monetary policy to be adjusted. But clearly, if the oil price remains elevated for a longer time period, then possibly they would have to adjust interest rates higher. But the net result is it sets the US up for interest rates over the next couple of months remaining where they are. There's still the prospect that there's scope for the US to cut rates. So if you look at the expectations, there's still generally an expectation that in the second half of the year, interest rates will be lowered. But in order for that expectation to be valid, you're going to have to see the oil price come down quite considerably, possibly back to around $75, $80 per barrel, and an end to the current war within Iran. So that, I think, is an absolute must in order to get an interest rate reduction. But in the meantime, I think most people accept that not just the US, many countries, their central banks are going to go into a holding pattern in terms of interest rates. The same would apply to South Africa. I think there's almost no prospect of an interest rate cut here in the short term. In fact, people are becoming concerned about the possibility of an interest rate hike within South Africa. Again, I don't think that's imminent. The oil price would have to remain elevated for a longer time period with evidence that it's feeding into other price pressures. But clearly the situation has changed considerably from where we were just a month ago. And obviously, it would help enormously if the war in Iran were to end as soon as possible. The second area of discussion is South Africa's GDP data for the final quarter of last year. During the quarter, the economy grew by 0.4%. And from my perspective, that remains incredibly low. If I look at the performance in the preceding quarters, also not encouraging, 0.3% in the third quarter, 0.8% in the second quarter, and only 0.1% in the first quarter. All of those growth rates well below what we really need. And so it means that for last year as a whole, the South African economy grew by 1.1%. Now, clearly many people are making quite a big deal about that relative to the last 2 years because it is a noticeable improvement. If we go back into 2024, the South African economy grew at 0.5%. So if you go from 0.5% growth to 1.1, it does sound like you're improving, but 1.1 is way below what the country really needs. We need to get South Africa's growth rate up above 3%, ideally up above 4% on a sustained basis in order to make a meaningful difference. I keep saying emerging markets on average, if we look at the group of emerging markets, they grow at around 4.1, 4.2% a year. And so that's the type of number that South Africa really needs to achieve. And yes, 1.1 is better than the preceding 2 years, but it's not going to make, and it didn't make a big difference to people's livelihoods, to income per person, to employment, all the key things we need to improve. It's just not fast enough. The other concern, I guess, is if we break down that data into the different components, it's very clear that the productive side of the South African economy remains incredibly weak. By that I mean mining production declined, manufacturing production declined, construction activity declined, transport activity declined, and electricity output declined. And those are the key productive parts of the economy. The parts that grew, obviously retail, trade, shopping activity, generally generally has been a bit more buoyant. And if we look at financial services and the banking industry, it has had decent growth. But we're not going to become an economic success story based on banking and shopping. We really got to get the more productive parts, the manufacturing, the construction particularly, transport activity. All of those sectors have to do a hell of a lot better, and all of those sectors declined in the final quarter of the year. And if I look at something like construction, which really is a key sector to South Africa's economic revival, that industry has now been in recession for 9 consecutive years. In total, over those 9 years, it's gone down by more than 35%. That's a massive loss to an industry that reflects the rebuilding of the South African economy. And it's telling you that despite all of the talk around trying to attract investment, get new initiatives in place, get more investment, if the construction industry is not growing, then where's this investment taking place? And the type of investment South Africa really needs is honestly the building of the infrastructure, re-establishing the port capacity, the rail capacity, the water capacity, and a whole range of other infrastructure that's been allowed to deteriorate. So if I look at the sub-detail within the GDP data, it's more disappointing than the headline number, and I didn't think the headline number was particularly encouraging. So the focus has to be on how we lift South Africa's growth meaningfully, but more importantly, how we lift the growth in terms of infrastructure development, because that way we can start to unlock other forms of private sector investment, and obviously we stand a better chance of creating additional jobs. And so this year, I think, has to be about getting the private-public partnerships to deliver a better outcome, making more noticeable progress on infrastructure development, and hopefully lifting the growth rate. Clearly, the high oil price is going to undermine those initiatives in the short term, but we remain hopeful that the war in Iran ends fairly soon, and then South Africa can start to move into a higher growth trajectory and end this year on a much better growth path than what we've got. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.